and Dow Jones both climbing more than 1%. Investors do anticipate further rate cuts, but there are concerns over the job market in the US, also that November the 5th presidential election. Very happy to say Jameel Ahmad, the chief analyst at GTC, is here, and he's usually based in Dubai, but he's visiting Istanbul, so you've been kind enough to come in. Jameel, just tell me one thing about the general picture about interest rates, because while they may have a positive effect on the economy, they can also have a negative effect on savers. So it's a delicate decision for any government.
It is, but I think it's about bringing some normality back to the global monetary environment, because you have to consider the 2020s so far, on an economic level, they've been brutal. We've had crisis after crisis, starting from the pandemic, then the crisis between Russia and Ukraine. Obviously, it was the latter that caused the largest inflation shock that many of us have seen in our lifetimes, if not a generation. And I think that now the central banks are trying to provide some confidence that they're in control of the inflation situation. And now they're trying to bring interest rates back lower. They're not going to be as low as what they were during the pandemic, but they're at least trying to provide some normality that they are going to be lower than the highest interest rate policy that some have seen in their lifetimes.
Yeah, okay, so some are cutting, some are staying the same. Brazil has been a bit of an outlier, raising its interest rate cuts. What about the Bank of Japan? What do you see there?
The Bank of Japan is in a very exciting position. Right now, they bit the bullet by keeping interest rate policy unchanged this month. I think that has something to do with the market volatility we saw in August, because we had unprecedented largest day of volatility that we had since COVID. So I think what the Bank of Japan are trying to do is they're trying to signal to the market that higher interest rate policy is coming. In fact, if the Bank of Japan do pull that trigger one or two more times, we'll have the highest interest rate policy in Japan this century. And Japan strategically has been trying to gear its economy towards higher interest rates. But what they've also tried to do is limit the market noise, because what happened with the Nikkei and the Japanese yen in recent weeks has been unprecedented. Having said that, there's still a lot of scope for a correction in the Japanese yen. We've had the dollar yen move from 160 to 140 in just a matter of weeks. I do think the scope is there for it to go towards 130. So over the final quarter of the year, we're still going to be keeping a very close eye on Japan.
Until a few years ago, China's economy was growing at that expected rate of 7 to 8%, the rate that is supposed to keep China's economy on an even keel. But it's been suffering economically in the past few years, and yet its rates are unchanged. Does that make sense?
It makes a little bit of sense, but I think that what the market wants to see and consumers is the Chinese central bank, the People's Bank of China, and the Chinese government do a bit more. I think the concerns right now is that the economic data is not convincing. We're starting to question whether the 5% GDP target for 2024 can be achieved. They would likely get over the line, but what would help get over the line with a little bit more speed and confidence is if we see more stimulus. It might be they wait until the final quarter, but generally speaking, we also have to take into account that the previous China of double-digit growth or going towards that 7-8%, that's not coming back anytime soon. China's in somewhat of an economic evolution as well, where it's trying to create different jobs in different sectors, artificial intelligence, more technology-based jobs, rather than manufacturing sector, which really drove the Chinese economy toward number 2. And we have to take that into account as well. But generally speaking, yes, there is scope and the need for the Chinese authorities to do more to help economic growth.
We have those numbers of the tech stocks in the United States climbing after the Fed's rate cut. When companies like Nvidia are going up and down so dramatically, almost in a 24-hour period, is that a dangerous kind of development in terms of how people are looking at what these tech companies might be worth in 12 months' time or in 24 months' time?
Yeah, we always talk about potential bubbles. The issue is that we've now been talking about bubbles in the tech sector for most of this decade.
Yeah.
What I think that's helping drive this rally is that nobody expected the Fed, the US central bank, to pull the trigger to a 50 basis point cut, which it did on Wednesday, which completely surpassed what the European Central Bank have done and the Bank of England over recent months. Because of this, and also because the tech sector has such a huge contribution towards the market value of the US stock market overall, that's why we're seeing more volatility. But generally speaking, the Fed have shown now that they're going to be aggressive. And if there are concerns that the Fed's fallen behind the curve or moving too late, they want to be in control of that situation. Historically, lower interest rates have been great for global assets and stock markets. So I think that what you're seeing in the tech sector is that they're dominant over the global market anyway. Now that the Fed has shown it's going to be aggressive and it will cut interest rates even more, that's why more money is piling into stocks once again.
Jameel, it's so great to see your face in person. I love your lapel pin as well. Thank you so much indeed for coming in. Enjoy the rest of your time in Istanbul.
Thank you.
Well, it's been a week of interest rate announcements. The US, Hong Kong, Brazil, Indonesia all making significant moves. Turkey and the UK, though, not adjusting rates.